You know, the biggest gap in markets isn't really about knowledge, it's timing. Institutional investors, well, they tend to move with liquidity cycles long before most retail investors even realize that conditions have changed. Liquidity, it moves in phases. It expands when capital gets easier to deploy and tightens up when funding pressure rises. Those shifts, honestly, they impact how easily markets advance, stall, or even correct. And institutions, they're watching those shifts early on. Large funds, they don't wait around for the public story to settle. They make their adjustments ahead of economic reports, policy decisions, borrowing conditions, and even quarter-end flows. By the time retail investors finally feel confident, institutional positioning is, more often than not, already in place. Retail usually reacts to what is already visible. A rally feels, a lot safer after it starts. And a correction, well, it just feels more dangerous after it accelerates. That delay, honestly, is what creates the liquidity cycle gap. This doesn't mean institutions are always right. It just means they operate earlier in the cycle. They respond when liquidity conditions begin shifting. Retail, on the other hand, often responds when price already confirms what liquidity had signaled before. That is exactly why cycle structure matters. It helps you identify when markets are being supported by improving conditions and when they're actually becoming vulnerable beneath the surface. The goal here isn't to predict everything, it's really just to stop reacting last. If you're ready to trade with more discipline, clarity, and confidence, and predict the market days or even weeks in advance, join the Market Turning Points community and visit stockforecasttoday.com.